Hey everyone, in today's video, we're going to be talking about whether Roth conversions make sense when you're on Obamacare, otherwise known as Affordable Care Act insurance. And this is a hot topic, especially for those that are retiring prior to 65, trying to implement some different tax strategies, as well as implementing those tax strategies in accordance to their healthcare planning. So we're going to be talking about this topic from a few different angles within this video. But before getting into the meat and potatoes, if this is your first time on our Safeguard Wealth Management YouTube channel and you like this video, you want to learn how to get more from the retirement assets that you already have saved up, go ahead and hit the subscribe button down below. Hit the notification bell. We release videos weekly. You'll be notified of all future videos that we release. Okay, so let's get into it. So when we're talking about Affordable Care Act insurance, really the focus of today's video is for those retiring prior to Medicare. So once you're 65 and on Medicare, you have a lot more room to perform Roth conversions. But prior to 65, you have limited healthcare options. Usually there's some kind of continuation from work that retirees often have. Now that's unsubsidized. So it tends to be pretty expensive. Most people will benefit from looking to the Affordable Care Act marketplace if they can control their income. Okay. And so we're going to be talking about Affordable Care Act insurance, public marketplace insurance, and how to not only earn a subsidy, but also still perform Roth conversions within this zone as well. So for those that don't know, a quick background on Obamacare. Basically, the amount that you pay for Obamacare insurance is tied directly to your reported income. Now, when I say reported income, what I'm referring to is something called modified adjusted gross income. Okay. Now, there's a few different modified adjusted gross incomes within the tax code. And so we're going to cover basically what that means here in a sec. But basically, two things will determine if you qualify for a subsidy. The first is household size. The second is that reported income. There are a lot of things that are counted in this reported income. Untaxed Social Security benefits, any distributions, capital gains, the amount that you have for a capital gain, that will be counted. There's a few things that aren't counted. And it's important to note this modified adjusted gross income as well is before the standard deduction. So don't take out the standard deduction and assume that's your reported income. You have to add back in that standard deduction. Okay. A few things that aren't counted, however, are Roth distributions. A Roth conversion would add to your modified adjusted gross income because in the eyes of the tax code, that's as if you're taking a distribution and then essentially converting it to a Roth. And so in layman's terms, basically, if you are below 400% of the poverty level, which as you can see here on the right side of the screen, find your household size here. And then this would be 400% of the poverty level. Basically, if you are below that, you qualify for a subsidy. Now, healthcare planning has become increasingly more complex within the last year because of the American Rescue Plan. So prior to the American Rescue Plan, there was something called the subsidy cliff. And this subsidy cliff will be back into law in 2023 and beyond. And basically, if you earn a little bit, or if you report a little bit too high of income, a few dollars more than the 400% poverty level, you essentially lose your subsidy altogether. So this makes a huge impact as far as how much you're going to pay for healthcare insurance. Okay, it might be something like before the subsidy cliff, you might be paying something like, let's say $700 a month. And then after the subsidy cliff, just earning a few dollars more, you might be paying something like $1,200 a month. So it's a huge, essentially, cliff that you do not want to go over. The American Rescue Plan changed things. Okay, it eliminated the cliff and made it much more gradual. Okay, so what does this look like? What's the difference between these two regimes? And it's important to note, American Rescue Plan is going to be what you're going to plan under from 2021 to 2022. 2023 and beyond, we're going back to the subsidy cliff unless Congress makes another change. Okay, so what this is going to show here, the difference between these two regimes, what you're going to notice is essentially the percentage of your income that you owe for healthcare. And what you'll notice under the past law, and this will be the past law. So this is prior to when they passed the American Rescue Plan. So this is the subsidy cliff right here. This is the past law. This is what we're going back to in 2023. You'll notice that earning a few more dollars and all of a sudden in this range right here, your healthcare premiums will skyrocket. So again, when you're performing Roth conversions, big message right off the front is you do not want to be subject to this subsidy cliff. Notice the American Rescue Plan down here, these proposed changes make it much more of a gradual slope here. Okay, so as you're adding to your income, reporting a higher income, your healthcare costs are going up steadily, and we can see this here. Okay, so critical takeaway before we even get into whether a Roth conversion makes sense, whether it doesn't. When you're assessing a Roth conversion, okay, especially in relation to Obamacare insurance, you want to think about your future expense rate, not just your tax rate. And what do I mean by this? Well, if as we're taking out more income, whether this be from just reporting a higher income because we're taking from traditional IRAs, or whether we're performing a Roth conversion and we're essentially owing more in healthcare premiums as we perform higher and higher Roth conversions, that's going to add to our expenses. It's not technically going to add to our tax rate. And what I want you to shift your thinking into doing is not just look at the tax rate, but look at the expense rate altogether. Because again, adding an extra dollar of a Roth conversion, obviously you'll owe taxes on that dollar, but then you may owe extra in premiums as well. Well, we want to add that premium extra charge onto our tax rate and get our expense rate. So again, as we're assessing whether a Roth conversion makes sense, we're assessing the expense rate of adding another dollar versus the tax rates we might be paying somewhere in the future. It's important to note if you're over 59.5, a Roth conversion versus pulling from a traditional IRA are effectively the same thing from a tax perspective, okay, in the following analysis. So basically, okay, let's say that you want to take $60,000 of income, but you only want to report, let's say, $40,000. Okay, whether you take that full $60,000 from Roth assets and perform a $40,000 conversion versus you take $20,000 from Roth assets and pull $40,000 from traditional IRA assets, again, from a tax perspective, those are effectively the same thing. We're minimizing traditional IRAs at the same extent either way of $40,000. In one example, we're pulling it as income. In the other example, we're performing it as a Roth conversion. So I'm going to talk about basically pulling from those traditional IRAs in the form of a Roth conversion. But even if you pulled that as income, they're effectively the same thing. That's important to note. Okay, so here are the healthcare tax bracket limits. Okay, it's going to break out 100%, 133, 138, 150, 200, and so on. So these are percentages of the poverty level. Your household size will be over here on the left. One household size, two household size. This is going to be the majority of the. Most people are going to be in one of these two cases, whether you're single or married. Again, if you have a handicap child or something, it may add to a third household, a person in the household. But again, most people are going to be focusing on these first two here. And basically, your tax rate, your added healthcare expense rate will go up as a percentage based on where you fall within these poverty limits. Okay, so these regular rates right here will be the healthcare cliff. This will be for 2023 and beyond. This is the American Rescue Plan right here. So this will be in force for 2021 and 2022. And what you'll notice here, focus on this column over here in both of these examples. And what you'll see is as you take out additional dollars from traditional IRA and report on higher income, or whether you're performing a conversion and thus reporting a higher income, in each of these poverty zones, you will have a different added healthcare expense rate. So if you're taking out additional income within this $150,000 to $200,000 range, or sorry, 150 to 200% poverty level range, for every extra dollar that you take out, you're going to add 2% in healthcare costs under the American Rescue Plan. Underneath the healthcare cliff, you're going to be adding 6.3%. So a big message here is for the next 2 years, you're able to take out more income. You're able to report a higher income. You're able to have larger Roth conversions without adding as much to your healthcare expense rate. Okay, and so I'm going to break this out into two different sections. We're going to talk about the American Rescue Plan first, and then we're going to talk about the healthcare cliff second. Okay, so underneath the American Rescue Plan, and I'm going to just focus on household size of 2 here. And what you'll notice, basically, for the next 2 years, and this will adjust slightly to inflation for next year as well, so this is looking at 2021, basically up to $26,130, you shouldn't see any added healthcare costs for taking out income in that range, for performing a Roth conversion within that range. From there on, at these different zones you'll see here, there's going to be 2%, 4%, 6%, 8.5% added. For every dollar that you take out, you're going to see your healthcare premiums rise by that percent. So my message here is add this into your tax rate. Okay. So for instance, if we're taking out $34,840, if we're taking up to that amount, I should say from $26,130 to $34,840. Okay, within that zone, as we take out additional income, we would be in the 10% bracket if we're taking the standard deduction. Add in, though, this extra 2% charge. Okay, again, if it makes sense to convert at 12%, you should take that added healthcare expense and basically perform the Roth conversion up to that amount. Again, as we go to the next limit here, this 250% limit, should we convert the extra, let's just call this $9,000? Well, again, if we're at 10% or 12%, add in the 4%, and does it still make sense to convert at 14 and 16%? So again, as you're stepping through each of these limits, you have to be assessing, does the conversion make sense? When we're looking at the full added expense rate, looking at your tax rate plus your healthcare expense rate, add those together. Does it make sense to convert through that? Okay, even up to the $69,680, anything over this, if you're continuing to convert, you're going to add 8.5% to your healthcare expenses. So again, in this range, you'd still be in the 12% bracket. Adding in the 8.5%, does it make sense to convert at 20.5%? So this is going to be for the next 2 years, 2021 and 2022. The American Rescue Plan certainly allows for larger conversions over these next 2 years because it's much more gradual of a slope. Okay, once we're in 2023 and beyond, okay, we have to look at it a little bit differently because again, those expense rates for healthcare are going up. So again, through each one of these zones, look at the tax rate that you will owe within this zone. Add back in the healthcare expense rate and see, does it make sense to convert at that marginal expense rate? Okay, so again, you will be owing more through as your healthcare expense rate through these different limits. But again, if you're adding 8.05% onto the tax rate that you'd be paying at that time, 12%, does it make sense to convert at 20.5%? Okay, and again, going through this, the big point here, though, is after this healthcare cliff, you do not want to go over this healthcare cliff. You will lose a subsidy altogether, and you will see a very high expense rate on those extra marginal dollars. So the big message here, in the American Rescue Plan, you can go over this, okay, and if it still makes sense to convert at that rate, go ahead and keep converting. Once we're back on this healthcare cliff, American Rescue Plan has ended 2023 and beyond, I would highly, highly, highly recommend not going beyond this conversion. Again, unless you're converting so many dollars because you're really trying to minimize some huge RMDs. But for the vast majority of people, you will not want to go over that cliff. Okay. And it's important to note it's not just the premiums as well. So as we're thinking about healthcare planning, don't just look at the premium cost and think that's the only added expense. If you have healthcare needs outside of that and you're going to end up paying a deductible, we also need to be focusing on the deductible. So you also need to think about, as you're healthcare planning, what is my need for healthcare over those next few years? Okay, so let's go through two examples. We have a household of two. This is under the American Rescue Plan, $30,000 of reported income. Notice the Silver 2 plan here. The monthly healthcare monthly premium would be almost $24. Important thing here to note, though, is the deductible and out-of-pocket maximum here. So the deductible is $0. The out-of-pocket maximum would be $5,700 for the family. So that's basically co-insurance on top of the deductible. Your share of costs going forward. You can see some of the co-payments and co-insurance down here. Okay, so let's say that we were going to convert $30,000 more dollars. Let's say it made sense from an expense, from a premium standpoint. Okay, well, if their reported income then rises to $60,000 because of that $30,000 conversion, notice what's going to happen to the premium. Again, this is what we would expect. Premium goes from $24 up to almost $360. But the important part, again, if you don't have healthcare needs outside of that premium, and again, these are going to be somewhat unpredictable. Obviously, we don't exactly know when we're going to have healthcare needs. But if you don't plan on having any big surgeries and you're pretty healthy, it may make sense to look primarily at the premium. But if you have additional healthcare needs, you want to be focusing on this deductible and out of pocket as well. Because again, sure, the premium added charge might still make sense to perform that conversion. But if you would need additional healthcare outside of that, we go from a deductible of $0 to a deductible of $10,400. The out of pocket rises as well, about $11,000. And so again, the premium might make sense to perform that extra Roth conversion. But if this family had some kind of surgery or some kind of added healthcare that they would need to be paying a higher deductible for, and they would be paying more out of pocket, again, it may not make sense, or almost guaranteed would not make sense to perform that extra Roth conversion on top of that. They go from a deductible of $0 to a deductible of $10,000. If they are maxing that deductible, well, all of a sudden we have an extra $10,000 that we need to add into that expense rate. So again, it's not just about the premium. You need to think about your ongoing healthcare needs as well as we're talking through Roth conversions. So the summary here, again, Roth conversions to an extent can often make sense. Underneath the American Rescue Plan, underneath the healthcare cliff, what I would urge you to do is add in these expense rates as part of that tax rate and assess, does a conversion make sense when I add in the extra healthcare costs in each of these regimes here? Also, don't just think about the premiums, think about the added out-of-pocket costs as well as you're thinking through Roth conversions. This can be a complicated situation. So we're kind of juggling a few things here. We're juggling tax rates as well as healthcare planning. If you're someone that wants additional advice on this, in the comments below, in the description below, I should say, there is a link. You can go to our website. There's also our phone number down there. Reach out, talk to one of our retirement tax experts. We can help wade through this complexity here. Always remember, though, you don't need more money. You need a better plan. Again, don't completely rule off Roth conversions just because you're on ACA insurance. With the different regimes, Roth conversions can still make sense going forward, but you want to make sure you're not converting too much and thus, after 2023, losing out on a subsidy altogether because, again, a subsidy is a big deal. Focus on the expense rate. Add in any out-of-pocket costs in your analysis. And again, Roth conversions can make sense. Thanks for watching. Hit the subscribe button if you like this video. We'll see you in the next video. Thanks.